Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. We've had some large sell-off in a lot of stocks from the comments from the Federal Reserve Powell, 50 basis point hike potential. But it doesn't stop the fundamentals, guys. It doesn't do really anything. We still have a really good fundamental structural setup in oil and energy in general. And I'm going to go over some information across the markets that I've grabbed from Twitter, and we can go through it together. I'll give you my financial opinion on it, and let's dive right in. So on the upper left, I've got Josh Young. He's a big oil guy. He's in the Bison interests. That's actually Josh Young. He says huge oil and products inventory draw. The draws will continue until supply improves. And when a draw is when it draws down on inventory. Inventory is being drawn down. So the EAI weekly oil and products inventory report, crude oil was down 8 million barrels. The SPR was down 4.7 million barrels. Cushing's down 0.1 million barrels. Gasoline's down 0.8 million. Distillate's down 2.7 million. Everything is down. So, I mean, domestic production 11.9, implied MoGas demand 9 million. I mean, this is a big draw here, guys. Big draw. And we're just eating through all the inventories. So prices are too low. You've got this is the option that you have. You can either bring on more supply or you have to destroy the demand to balance out the inventories. I think we're going to do both. I think we're going to get a little bit of supply, and I think we're going to get a whole bunch of demand destruction with far higher prices. Far higher. Paul Sankey. Paul Sankey says oil could hit 10% of the S&P 500. I put the SPX here. That's at 4,459 when I ran this. So he thinks that oil could potentially go to $445 a barrel. I like it. This could obviously go down. It could be at $300 or $400 a barrel, and that's probably about where I have it. About $300 a barrel, $400 a barrel, $250. It all depends on where these two meet. Yeah, he could be right. Definitely. What I have down here is the PPI. So this is your producer price index by commodity of all commodities. Look at what's happening during these large inflationary breakout periods. We've got this big, huge break here of the commodities. And this is the current information that we have. And it's just going vertical. It's going more vertical. And if you look at this chart kind of as a holistic, we had very small percentage gains. Or I should say it was the curve was very flat at the bottom here. This was a move, but it's, percentage wise might be the same as this. I don't think so, but if you look at it, it's starting to get steeper and steeper and steeper, and this could just go vertical. That means that we could potentially be in a hyperinflation type a hyperinflation type move. And the commodities here are showing that type of movement. It is vertical. Now, I don't know. I mean, we'll see what happens moving forward. I'm not claiming a hyperinflation or anything like that. I'd like to see what happens first. Next is the expansion phase of the real estate have higher CPI rates. This is consumer price index, and this thing's starting to turn and really turn up as well. You can see the small deflation. This is the deflation from real estate loans and the collapse here. That little small movement downward is a deflation. So we haven't had a deflation till maybe like this little spot here in 1980s. There was a little blip. There was a little blip here in 2008-9, little blip here in 2020. But these blips are really small and they don't last. So I'm not worried about the small deflationary blip. I'm worried about this big inflationary move that's coming. And that's how I've positioned the portfolio. This is the United States inflation rate. Remember, over time, this is 1920 all the way till today. And this is the downtrend line. We're breaking this downtrend line. We've already broken it. I'm going to say that. Why do I say that? Because the way they calculate the number today is completely different than the way they calculated it back here. If you calculated it the same way the entire time, we'd be probably up here, which means we've completely broken out of this channel here, which means we could be seeing a massive inflation problem coming right ahead of us. Inflation problems don't work their way out with interest rates at point whatever percent or 3% or whatever it is. The Fed funds rate's going to go way up. The 10-year yield's going to go way up, and we'll see where things start to break. Things will start breaking at some point. What do I mean by breaking? there's going to be like defaults and credit problems somewhere in the system. And remember, house prices might remain pretty resilient in a condition where you've got massive inflation, because people are then going to start looking at how can I get money out of bonds as quickly as possible. So you're going to see interest rates go up. Everything's going to look like it's unaffordable, and the middle class, so they're going to eat it. Of course they're going to eat it if you have really, really high inflation rates, because money's going to rotate out of the market. And what you're going to see is you're going to see hedge funds starting to buy real assets all over the place, almost as if they know that a hyperinflation is coming, kind of like a BlackRock would be buying real estate. Oh, wait, that's what they're doing in all cash offers. Why are they doing that? Probably because they know what's coming. That's probably why. The best thing you can do as an individual is to buy a house and lock in your costs. You don't want your costs to go up because rent prices can go through the roof. And that's what we're seeing is rent prices going through the roof. So here's this. German PPI at 31%. Worst ever in the time series history. Ouch. Just ouch. 31% in their producer price index, guys. This is absolutely insane how much inflation's out there. And this is related to energy prices, in my opinion. So here we go. It says, until December 31st last year, Germany's nuclear plants made 12% of the nation's electricity for 20 cents per megawatt hour. Now they make 6% of the nation's electricity for 20 cents per megawatt hour. They're being replaced by electricity that costs between 50 and 300. Maybe someone should look into that. And they're talking also about the producer price index. JP Morgan, immediate EU ban on Russian oil could send oil prices to $185 a barrel. That's pretty crazy. This is the 10-year yield. I'm just showing you kind of this. This was actually up today. This was 1 day delayed. But this is an inverted head and shoulders. It's broken to the upside. It's running. I think we're probably going to get up here at about $3 or 3.2%. So I think we're still going to keep moving higher in the 10-year yield. We've got Grady. Grady, I follow him on Twitter. He said, this chart does not need any further notation or indicators, etc., other than just those 3 lines. The message of the 25-year blue channel breakdown is pretty clear. And what he's showing is that we have inflation, and this is the 30-year bond yield breaking its lower trend line to the downside. What that means for USB is, it's not yield, sorry, it's the pricing of it. So the pricing has broken to the downside, which means that people are selling bonds, that interest rates are about to go up. So bonds going down means yields are going up. So that's there. I thought that was a pretty interesting comment. Another one, it says, forget seasonal charts, just look at this. This is including the SPR. This is our crude oil total inventory index, and it's just depleting straight lower. We need higher prices, and we need it immediately. We are going to be depleting our inventories worldwide. And then once these are depleted, the price of oil is going to go ballistic, because we're going to get to areas that are so low and so critically low that we, one, are going to be out of spare capacity, and two, will have less inventory to deal with any supply problems. So the only factor is to destroy demand, and that will be through prices. And it's coming. Elon Musk says he thinks inflation is worse than reported and likely to continue through 2022, obviously. Says, I think the official numbers actually understate the true magnitude of inflation, and inflation appears to be likely to continue for at least the remainder of this year, said the Tesla CEO. And I agree, it's going to last longer than that, too. Here's Ken Cotto. I like this thing. He goes, I have no idea how this plays out, but the one thing I do know is that the masses have a terrible track record for forecasting macro. I totally agree. I hear a lot of people all calling for a housing market crash, but we don't have any inventory. I'm sorry, it just doesn't work like that. A bubble is to basically say that you have excess. And everyone else right now is forecasting that a bubble's coming. What if we have hyperinflation? You think that bubble's going to come? No, what you're going to see is people are going to run at everything that's real assets with everything they've got. They are going to leave cryptocurrencies because they have no value. They are going to leave anything that is a speculation when everything was in abundance before. They're going to run towards energy. They're going to run towards things that they need to live. They're going to sell their crypto in order to live. So they're going to go after real assets or real things that they need in their life. Food, water, housing, and what's happening? What is happening right now? Rent prices are going through the roof. So I'm gonna come in here real quick and just do a quick rant. It's on Twitter. Everyone thinks that the only thing that's important is mortgage rates for the affordability of homes. I'm going to tell you this, okay? Affordability is one aspect of many things in this housing market, and this is why why most of these people are so bad at macro. And obviously, I'll change my tune if the inventories go way up, but you can't be in a bubble if you have no inventory of that thing. People will say, well, that's only one half of the story. It's not one half of the story. It is the story. It is the story. Demand and supply interact with each other, and the output either draws from inventory or adds to inventory. If we're at record low inventories of 2 months of inventory, if we're at record lows, that means we've been drawing from inventory. The market has. If we're drawing from inventory, we are running a deficit. If we're running a deficit and we have no inventory, that by definition is not a bubble. So if you're in the bear camp for housing, we are in the expansionary phase where there's a large imbalance between the buyers and sellers that are accelerating everything to the upside. That will first have to slow, which means rather than having 10 buyers for every seller, it'll go to 5 buyers for every seller, or 2 buyers to every seller, or maybe we're getting closer to that point where things start to normalize. Now with interest rates going up and whatever. But guess what happens next? If you can't buy a house, you have to go rent. And what are rent prices doing? They are going vertical. Some of these are going 50% up year over year in terms of their rent price increases. The problem isn't solved. If people can't afford to buy and they can't afford to rent, there's a problem. That's the problem. We are going to have to price people out of rent. We're going to have to price people out of homes. They're going to have to go live somewhere else. And if they can't afford to, I don't know what happens. This is a bad situation. We are short homes. That is the demographics, the root of the problem, and not having enough homes and that interaction with the demographic. So even if people are calling for a crash in house prices, it can't crash because you have everyone underneath it that wants to buy homes. Everyone's like, oh, I'll just save some more and I'll buy it a year after. You know how many people are saying that? It's like everyone on Twitter saying that. I hear this all the time. Oh, I'll just wait a year. I'll just rent and I'll buy. It's like, wait until your rent prices go way up, and then you have to be forced to buy. This isn't like we're just sitting around with an abundance of homes. We don't have the homes. Anyone who says that there's not a shortage in homes is on crack. Why? Because if we had an abundance of homes, if it wasn't a structural shortage, you'd have rent prices be cheap, and you'd have home prices going up, and you'd see your home price to rent ratio go all crazy. It's not, though. Rent prices are going up a lot. So I think there's a real physical shortage. Now, does that mean that some people own multiple homes? Some people can own multiple homes and they could sell more. They can either sell them or they don't sell them. I don't know what that is, but there's nothing in inventory. That's what I can tell. So I just wanted to kind of go into that. So looking at this, we've got Grady again. It says, to follow up on how to get out of the rat race, besides hard work, strategy, stamina, mental shape, discipline, making sacrifices, maxing income, minimizing consumption, etc., you also need to bet on the right market. This chart gives you which market to go for. Commodities. This is the commodity to Dow quarterly ratio chart, and commodities are starting to outperform against the Dow Jones. I use the S&P 500. We can use all these different ones. The S&P 500 already broke out to the upside. This is a big old move, I think, coming to the upside. And once we break out of this pattern, it is going to be epic. It said back in April 2020 that this 60-year blue falling wedge would reshape the investment world. It did and is, and it will. Trust me. This chart shows the commodities complex CRB versus the general equities market. And it shows commodities starting to outperform general equities big picture, turning the tide. After the general equities tops, there will only be one game in town. Commodities. Why? Because of the dollar, the currency. This currency, I mean, when you start tying everything I have in this presentation here, this clip, inflation's coming, guys, and it's going to be massive, and the money is going to flow where it's safest and where people need it, which is commodities. There's going to be fights over what's left, in my opinion. And if we have a big shortage in commodities, anything that has sunk minerals and sunk energy into it, like used cars, we've seen that go up. We're going to see pricing of homes go far higher. We're going to see a shortage of a whole bunch of different things, I think, coming up over the next years. Here's some other factors here. This is about real estate. Silly millennial, don't understand what real high interest rates are. Look at the historical data. Also, rates isn't a factor. It is the number of qualified buyers that can afford that in comparison to the available inventory. It's the qualified buyers versus the available inventory. This person knows exactly what they're talking about here, this noob guy or girl or whoever. It says, in our current market, many locals have multiple bidders and homes are going 15, 20, 40% over ask. In this scenario, what percentage of those bidders were even viable participants, and does their removal really change the dynamic? And that's a really good question. The people who can't afford homes aren't the ones getting it anyway. So if you take those people out with higher interest rates, and most of these, I think it was something on the lines of 25% of the homes sold, and I can't remember if this is Canada or America, were all cash buyers. I was like, that was an absolute eye-opener to me, because most of these don't even need interest rates. It has nothing to do with it. So it really depends on who we're pricing out here. We might be pricing out a bunch of people that do not matter. They're already priced out of the market. So I'm curious to see what inventories do with these higher rates. I'm very interested. It says it's not that real estate that is going up. Think GFC with no inflation. It's the dollars that are becoming worth less in the real world. Look around, the price of everything is going up. This is currency devaluation. It just stands out and gets more attention in housing. And I completely agree. The denominator, the dollar, is getting smoked. Prices have to go up. Now, here's something else. This was an article I was looking at. It says the price of a home sold in March set a record as inventory dwindled and sales fell. March sales were 4.5% lower than the same period in 2021. Everyone, the sales are lower. If you have nothing to sell, you can't increase your sales. That's based off volume. That's not based off price. The median price of an existing home sold in March was $375,000, an increase of 15% from March 2021. That's the highest median price ever recorded by the realtors. At the end of March, there were 950,000 homes for sale, a decrease of 9.5% year over year. 950,000 homes for sale. It's a 2-month supply at 950,000 homes. So in order to get to crash territory, I'm just going to say this, 10 months is crash territory of inventory. If it's 950 we'll call it 1 million. If it's 1 million every 2 months, and we have to go from 2 months to 10 months, that's an 8-month increase. An 8-month divided by 2 is 4. 4 times a million is 4 million homes. We need 4 million homes in inventory with no one buying anything to get to crash inventory level. There's not that many homes in forbearance. Then you've got a larger demographic coming. We did the math. Me and a guy at work did the math. He calculated that in order to stay flat in the housing starts, based off of the larger demographic that's coming, they have to produce 1.8 million homes per time. So 1.8 to basically remain flat. That's based off the demographic increase. These are engineers playing with numbers. I don't care about these other people who have these weird whatever. If you don't build more than 1.8, you don't get out of the problem. The problem will still persist in the market. We're short 7 million homes from not building the previous years. So we're in an underbuilt scenario of depending on the numbers, 5 to 7 million homes. We need to build 1.8 to remain flat. We got to go to 2 million or 2.2 million to catch back up on the housing starts. If we don't catch back up on the housing starts, interest rates don't matter. You're still short homes. So you're either going to eat it to buy the house or you're going to eat it in the rent price. You choose. It's not someone saying, It's not something I can't afford to buy this house. But okay, then what are you going to do? You're going to go rent that you can't afford to rent. So now you're going to be piling up multiple people to go rent. And that's exactly what's happening next. You're going to have a bunch of people pile in together. They're going to afford these very high rents. And that's going to force people to do that. The pricing will have to be so unaffordable that people are going to be huddling together multifamily and single family homes. Or we're going to build a whole bunch of multifamily homes or multifamily units, condos or whatever. That will probably be next. And a lot of these people won't be able to afford single family homes. They're going to have to go into something else, unfortunately. But that's the current situation that we're in. And that's how it works. And here's another thing. In the 1980s, I don't know if interest rates are the ones that actually that beat the problem. The demographic could have run out. If the demographic ran out and the interest rates had nothing to do with it, the interest rates were just chasing the demographic in the problem in housing. So that is what could potentially be coming, is very high interest rates because of very large inflation and very acute shortages in many things, commodity related and also in housing related. So we'll see what happens, guys. I don't want to try to predict the future, but I'm seeing the trends, and these trends are probably going to extend into the future for a good long time. I think we probably may even have another 8 or 10 years out of this thing. I don't think we can catch up very quickly in the housing market. I think this housing market is super tight, and it's going to remain tight for a long time. So that's my opinion on it. If I'm wrong, we'll see it in the inventory. We'll have plenty of time to adjust. But my take on it is, that's why we see rent prices so high and going crazy. So people can't afford to buy, and then they're just going to start piling it on rentals. So that's my take, guys. If you guys like the content, give me a thumbs up. Subscribe to the website, Platinum membership down below if you want. If you like these types of, if you like my viewpoint, if you like my critical thinking, sign up. You're going to get it. You can ask questions during the question and answer session that we're having Saturday at 7 a.m. So you can sign up. We can do that question and answer session, and you can ask questions about all this, and I'll give you my answer directly. All right, guys, we'll catch you next time. This is Finding Value.